For more on how to navigate the market's recent volatility, let's bring in RBC's Lori Calvasina. Lori, great to see you.
Good to see you too. Thanks for having me.
You recommend a sort of barbell approach to this whole thing. You're not going to say all in on value or all in on growth. You're saying a little bit of both.
That's right. I mean, we've looked at the value trade, we've looked at the growth trade, and we also look at it through the lens of cyclicals versus secular. And we feel like there is room still for the value trade to do quite well from a valuation perspective. We need a lot of things to go right. We need COVID cases to improve, which frankly has been happening. We're seeing that rate of change come down, and we're finally seeing, sort of the peak in the COVID cases a lot of people had expected. But we also think that Fed rate hikes are pretty toxic for the value trade, are historically pretty toxic for cyclicals. So we think we're going to nice, sort of outperformance in the intermediate term in the value trade kind of into the middle of next year. But unfortunately, whenever the Fed hikes rates, small caps usually peak versus large, value peaks versus growth, and cyclicals peak versus secular. And so we don't think you want to get too comfortable. We think you just want to stay in the best of both worlds, to be honest.
Lori, it's Tim. So in your barbell, I know energy fits in there, and you have banks in there, and they may sit on the same side of the barbell. Which sector do you think in the near term has more oomph to it? They both run.
Yeah, look, I would say from a valuation perspective, financials and energy, they both look pretty similar. They both still look pretty undervalued to us. And we've liked energy in part because the earnings revision trends have been so unbelievably resilient. It's one of the best sectors in terms of the rate of revisions to the upside. Now, financials is the one I'm watching. They report early. And what's interesting about financials is that the revisions have weakened a little bit. They're not bad. They've weakened a little bit from their peak. But historically, when you get an upward move in the 10-year Treasury yield, you get upward revisions in financials because of the influence on bank stocks. So I think that's really one thing to watch early on in this reporting season if we actually see some momentum come back to financials earnings revisions.
Hey, Larry, it's Karen. Thanks for coming on. Financials is a sector I follow a lot closely. So within financials, are you differentiating between like sort of an old line JP Morgan and, a Square or a something more fintechy?
Well, the way we do the work is on the GIC sectors, and I would tell you that we're seeing the attractive valuations and that interest rate sensitivity in the traditional banks. Sort of the fintech part of the market, we think that you really just don't have the same kind of valuation appeal. That's really sitting more in the tech sector, to be honest. So we look for the kind of boring old economy type banks.
Lori, we've been hearing so much about the surge in energy prices, and I'm wondering at what point does this it become a headwind for either corporations or the consumer?
I think it's a great question, Melissa. I think we've got to watch in this next reporting season what we see in terms of comments on energy prices. I do think a lot of companies hedge, so I don't think that that's necessarily as big of an issue as it was, say, 5-10 years ago. I think the ultimate impact probably is more on consumers. And we did not see sort of late in the last reporting season. A lot of those consumer companies reported kind of mid to late August. We didn't really see a lot of complaints about energy prices back then. That doesn't mean we won't get it this time around. But I do think that consumers do still have ample cash cushions, so they can still absorb some of these hits. But you're right. I mean, it's clearly something we've got to watch in here.
Lori, great to see you. Thanks for your time.
Thanks for having me.
Lori Calvasina. Guy, you like that barbell approach? A little bit of each end, so to speak?
I like what she's putting down. Good for her. She does great work, and I'm with her. I mean, my biggest concern continues to be margins, right? Are these companies, corporations, retailers, are they able to pass on what are going to be higher costs to their end users? I'm not certain that's the case. So if margins comes in, we start after questioning valuations. That's been my concern for a while. And we'll see it manifest itself in this earnings period we're about to embark upon.
Isn't that sort of a push-pull, Karen? Because, certainly if companies can't pass that cost on to the consumer, then the margins come in, which is bad for the stock market. But at the same time, if they do push it on to the consumer faces inflationary pressures. It's sort of, it hurts one area, and eventually it translates back to stocks, no?
Yeah, that's a very good point. But I would also add, though, that the consumer, to the extent the consumer is working, they're probably earning more. So that's another part of the inflation chain, right? Hourly wages going up. So I don't know, we just maybe get in this spiral of up and just passing the buck along. So I'm not sure which weighs the most. But if you have an excellent brand, you're far more likely to be able to pass on that that whatever cost pressures you may see, even labor, to the consumer.